What if the ETF you trust most, the one you proudly call your cornerstone, was actually holding you back? I'm talking about SCHD, yes, the beloved dividend fund that everyone swears by. It's reliable, it's consistent, it's built for income, but here's the uncomfortable truth. SCHD alone might be costing you $100,000 in potential gains over time. Now don't get me wrong, SCHD is one of the best dividend ETFs ever created. It's built on strong fundamentals, but on its own, it's like having a rock-solid defense without an offense. You'll survive the market storms, but you won't win the championship. And in the investing game, winning means growing your wealth and generating income. So here's what we're doing today. We're going to fix that. You'll see exactly which two ETFs can supercharge SCHD, one focused on long-term growth and one that turns it into a monthly income machine. By the end, you'll know which path fits your goals, whether that's building future wealth or collecting cash flow right now. Before we dive deeper, quick reminder, hit subscribe to MoneyQuest Broker so you don't miss future breakdowns like this. It really helps more people find videos that make investing simple and smart. Alright, let's start with what SCHD actually gives us. As of October 2025, it manages over $70 billion in assets. Yes, billion with a B. The share price hovers around $27 and it tracks the Dow Jones US Dividend 100 Index, but what makes it special isn't just dividends, it's the quality filter. SCHD doesn't just chase high yields, it looks for companies with strong cash flow, low debt, high return on equity, consistent payouts, and at least 5 years of dividend growth. That's elite. It currently yields about 3.87%, paying quarterly, and its dividends have steadily climbed, from $0.17 per share in 2021 to around $0.26 in 2025, and it does this at an expense ratio of just 0.06%, basically $6 per year for every $10,000 invested. Those numbers are hard to beat, but here's where things get interesting. SCHD's top holdings, AbbVie, Cisco, Merck, PepsiCo, Coca-Cola, Lockheed Martin, Chevron, Altria, and Home Depot, are the definition of stability. These companies print cash, yet when you dig deeper into the fund sector mix, you start seeing the gaps. Energy makes up about 19%, consumer staples 18%, healthcare 16%, and industrials 12%. These sectors keep the economy running, but, honestly, they're not exactly where explosive innovation happens. The information technology sector, the one driving modern wealth creation through AI, cloud, and semiconductors, well, it's barely 8.3%, and yeah, that's where SCHD starts falling short. Because while tech's been launching portfolios into orbit, SCHD has been quietly jogging on the sidelines. Year-to-date through September 2025, it's up 2.84%. Steady, but not exciting. Over the past year, just 0.56%. Meanwhile, funds in its same value category are up over 11%. Over the long run, SCHD shines, about 11% annually over 3 years, 12% over 5 and 10 years, but lately, it's missed the market's biggest moves. That's not a flaw, it's a signal. SCHD is a defensive masterpiece, but it's incomplete. It needs an offensive partner. So, if your goal is growth plus dividends, there's one ETF that fits perfectly. SCHG, the Schwab US Large Cap Growth ETF. Here's why it's the ideal pairing. SCHG manages around $51 billion and tracks the Dow Jones US Large Cap Growth Index. It focuses on companies with rising earnings, accelerating sales, and innovation-driven momentum, the kind of businesses shaping the future. Its yield is tiny, just 0.34%, but don't let that fool you. This fund isn't built for income, it's built for expansion. The expense ratio is even lower than SCHD's, at 0.04%, and its top holdings read like a roll call of the modern economy. Nvidia, Microsoft, Apple, Broadcom, Amazon, Tesla, Meta, Alphabet. Nearly 48% of SCHG sits in tech, with another 14% in communications and 13% in consumer discretionary. In other words, where SCHD plays defense, SCHG plays offense. They move in opposite directions, and that's exactly what makes them powerful together. And here's the magic number. 0% overlap. Every $1 you put into SCHD and SCHG is invested in completely different companies. That's true diversification. Now for the performance. SCHG is up 14.8% year-to-date, with a 23% one-year return, 32% annualized over 3 years, and nearly 18% over 5 years. Since launching in 2009, it's averaged almost 17% per year. Combine it 50-50 with SCHD and rebalance once a year, and a $10,000 investment back then would be worth around $556,000 today, even beating the S&P 500. Better yet, that combo still gives you about 2.1% dividend yield, higher than the S&P's 1.3% with more growth. Imagine you're in your 20s or 30s starting small, say $300 a month plus an initial $2,000, with historical returns and reinvested dividends. That simple SCHD plus SCHG blend could reach roughly $1 million in 25 to 30 years. That's the power of balance, income plus innovation, working together. Of course, growth comes with volatility. SCHG's standard deviation is 16.3%, which is higher than SCHD's 14.5%. When tech dips, it really dips harder. And, valuations are pretty steep, 39 times earnings, 10 times book value. But for investors with 10 years or more ahead, this mix is honestly one of the most efficient, cost-effective, and proven two-fund strategies around. Now, let's talk about the other side of the coin. Maybe you're not chasing long-term compounding, maybe you're retired or just want dependable income hitting your account every single month. In that case, your perfect pairing isn't SCHG, it's JEPI, the JP Morgan Equity Premium Income ETF. This one's built for yield. It manages around $41 billion, trades near $57 per share, and uses a clever two-part approach, 80 to 90% in large-cap U.S. stocks and 10 to 20% writing-covered call options on the S&P 500. In plain English, it sells insurance to other investors, collecting cash premiums every 30 days in exchange for giving up a bit of upside, and those premiums add up fast. JEPI's 30-day SEC yield sits around 7.17% with a 12-month rolling yield of 8.3%. On a $50,000 portfolio, that's roughly $4,000 per year, paid monthly, not quarterly, every single month cash in your account. The expense ratio is 0.35%, but that's a fair price for active management that actually works. Its top holdings include Alphabet, AbbVie, Microsoft, Meta, MasterCard, Amazon, and Johnson & Johnson, blue-chip names, not risky high-yield traps. Sector exposure is balanced. About 15% tech, 12% healthcare, 12% financials, and healthy doses of staples and industrials. Performance-wise, JEPI's up about 5% year-to-date, with a 4.3% one-year return and roughly 13% annualized over 3 years. It's not a rocket ship, but it's not meant to be. During downturns, it cushions the fall. In the 2022 correction, SCHD dropped over 21%. While JEPI fell only 18%. That premium income acts like shock absorption. So, the trade-off. In strong bull markets, JEPI tends to lag behind. Those call options really do cap the upside, so you're never going to see 30% years with this fund, but, on the bright side, you will see pretty steady income. If you combine SCHD and JEPI 50-50, you're looking at about a 5% to 7% blended yield. That's around $5,000 to $7,000 a year on $100,000. And honestly, that's nearly 4 times what the S&P 500 pays out. Of course, nothing's perfect. JEPI's distributions can actually be a bit tax inefficient, partly qualified dividends, partly return of capital. So, it's really best suited for tax-advantaged accounts like IRAs or 401ks. So, which do you choose? Well, it really depends on your goals. Choose SCHG if you have time, want growth, and can handle volatility. Or, choose JEPI if you want monthly income, stability, and are closer to, or already in, retirement. And hey, you could even blend all three if you want balance. SCHD for quality, SCHG for growth, and JEPI for cash flow. Here's the truth. SCHD isn't broken. It's just one piece of the puzzle. Combine it wisely, stay consistent, and let time and compounding do their magic. Because honestly, real wealth isn't built on timing the market. It's built on discipline, diversification, and patience. And one more thing. This video is for educational and informational purposes only. The data discussed reflects historical performance and public information as of the stated dates. Past performance does not guarantee future results. Always conduct your own due diligence and consult a licensed financial advisor before making any investment decisions.